Money makes the world go round, but do we truly understand its value and its risk? Join us on a journey to unravel the mysteries of money and discover its true worth in our lives. What is financial risk? Ang financial risk ay tumutukoy sa possibility of losing money sa business or investment. Ito ay maaaring magresulta sa pagkawala ng capital para sa mga individual at negosyo. Kapag may financial risk, may posibilidad na ang cash flow ng isang company ay hindi sapat upang matugunan ang mga obligasyon nito. In government sectors, financial risk implies the inability to control monetary policy and or other debt issues. There are 5 types of financial risk. Firstly is the market risk. This type of risk arises due to the movement in prices of financial instruments. It can be classified as directional risk and non-directional risk. Directional risks are those risks na nalulugi yung assets dahil sa exposure nito sa market. For example, an investor that have shares will experience a loss kapag bumaba ang presyo ng mga shares sa market. On the other hand, non-directional risk arises when the method of trading is not consistently followed by the trader. For example, bibilhin at ibebenta ng dealer ang mga shares ng sabay-sabay to mitigate the risk. Second is the credit risk. This type of risk arises when one fails to fulfill their obligations toward their counterparties. Credit risk can be classified into sovereign risk and settlement risk. Sovereign risk usually arises due to difficult foreign exchange policies, while ang settlement risk ay nangyayari kapag ang isang partido ay nagbabayad habang ang isa pang partido ay hindi natutupad ang mga obligasyon. Third is the liquidity risk. This type of risk arises out of an inability to execute transactions. Liquidity risk can be classified into market or asset liquidity risk and funding liquidity risk. An example of market or asset liquidity risk is meron tayong real estate. Pero dahil sa bad market conditions, yung real estate natin ay mabebenta lamang agad-agad kapag ang market price ay mas mababa sa market value nito. Ang funding liquidity risk naman ay ang hindi kakayahang pondohan ang mga liabilities na nagdudulot ng pagkalugi. Fourth is the operational risk. This type of risk arises out of operational failures such as mismanagement or technical failures. Operational risk can be classified into fraud risk and model risk. Fraud risk arises due to the lack of controls and model risk arises due to incorrect model application. Lastly is the legal risk. This type of financial risk arises out of legal constraints such as lawsuits. Kapag ang isang kumpanya ay nahaharap sa mga pagkalugi sa pananalapi dahil sa mga illegal na kaso, it is a legal risk. Financial risks for businesses. Financial risk may be due to several macroeconomic forces, fluctuating market interest rates, and the possibility of default by large organizations or sectors. When individuals run businesses, they face financial risk in making decisions that jeopardize their ability to pay debts or income. Mahal at komplikado ang pagtatayo ng isang negosyo. Madalas, kailangan ng mga kumpanya na humingi ng puhunan mula sa outside resources upang mapanatili ang kanilang paglago. Ang pangangailangang ito sa puhunan ay nagdudulot ng financial risk para sa kumpanya or negosyo na humihingi ng halaga at para sa mga investor or stakeholder na nag-i-invest sa negosyo ng kumpanya. There are 3 types of financial risks that happen in business. First is the credit risk. Kung hindi mababayaran ng borrower ang loan nito, it becomes default. The investors suffer from reduced income from loan repayments, interest, and principal. Second is the specific risk. Ang uri ng risk na ito na kaugnay ng company or group of companies ay may kinalaman sa istruktura ng capital, posibilidad ng hindi pagbayad, at mga transaksyon sa pananalapi. Third is the operational risk. Ito ay nagaganap kapag ang mga negosyo ay may hindi magandang pamamahala. Financial risks affect businesses in different shapes and sizes. Financial risk awareness is a must. However, knowing the dangers and strategies to protect oneself does not eliminate the risk. It mitigates the harm and reduces the chances of negative outcomes. Financial risk for the market. Often, financial markets are a hub of financial risk as several circumstances can impact them. Kapag ang isang mahalagang sektor ng market ay nahaharap sa isang financial crisis, ito ay nagiging banta sa kabuuang kalagayan ng market. There are four types of financial risk that happens in the market. First is the volatility risk. Nagbibigay ito ng kaalaman tungkol sa pag-angat o pagbaba ng market. Ito ay maaaring magdulot ng malalim na pagbabago sa presyo ng mga stocks sa market. Second is the market interest rate changes. It tends to push individual securities into unprofitability for investors. They are forced into lower paying debt securities or negative returns. Third is the defaults. It occurs mainly in debt or bond market when issuers or companies fail to pay their debt obligations. Investors are harmed severely by defaults. And lastly is the asset-backed risk. An example for this is when a borrower who took money for a certain period pays off the debt early, ang maagang pagbabayad na ito ay nagtatapos ng kita mula sa mga bayad. Ito rin ay nag-aalis ng potensyal na kita mula sa malalaking pagbabago sa mga interest rates. Financial risk for governments. Financial risk for a government arises in the following situations. Government losing control of its monetary policy, its inability or unwillingness to control inflation, government defaulting on its bonds, other debt issues. A government issues debt in the following form: bonds, funding wars, building bridges, building infrastructure, paying for general day-to-day operations. Financial risk for individuals. You too can fall prey to financial risk if you make poor decisions. Isa sa mga karaniwang sanhi ng financial risk ay ang pagkuha ng hindi kinakailangang araw ng pahinga sa trabaho. Iba pang mga sanhi ay ang mga pampalagiang pamumuhunan. Dapat maunawaan ng bawat individual na ang bawat gawain ay may kaakibat na potensyal na panganib. May mga panganib na hindi kontrolado ng isang tao, kaya mahalaga na lubos na maunawaan ang mga bunga o kahihinatnan nito. There are three financial risks for investors. First is the market liquidity risk. Ito ay nauugnay sa mga ari-arian at mga panlabas na seguridad na hindi mabebenta o mabibili sa isang halaga na makakapagbayad sa mga pagkalugi sa pabago-bagong market. Nangyayari ito kapag maraming nabebenta pero kaunti lamang ang mga bumibili. Second is the funding or cash flow liquidity risk. Ito ang posibilidad na ang isang kumpanya ay hindi magkakaroon ng sapat na puhunan upang bayaran ang mga utang nito. Kaya naman, ito ay napipilitang hindi magbayad at nagdudulot ng pinsala sa mga may-ari ng kumpanya. Third is the speculative risk. Ang hindi tamang pag-research ng isang investor bago mag-invest ay nagdudulot ng posibilidad ng speculative risk. Ito ay nangyayari kapag labis silang umaasa sa malalaking kita o nag-i-invest ng malalaking halaga sa isang particular na investment. If you have an inflow of foreign currencies, you can also be exposed to currency financial risk as the following factors affect your calculated finances. The interest rate changes, monetary policy changes, changes in prices due to market differences, political changes, natural calamities, diplomatic changes, economic conflicts. Pros and cons of financial risk. Understanding and assessing the degree of financial risk associated with an asset can lead to better and more informed business decisions. The pros of financial risk include facilitates more informed decision, assists in assessing value, and it can be recognized via analysis tools. While the cons of financial risk include often arises from unpredictable outside forces, it can be uncontrollable or difficult to overcome, and it can spread to different sectors or markets. Tools to monitor financial risk. May ilang mga pamamaraan na makatutulong sa mga individual, pamahalaan at negosyo na matiyak ang antas ng financial risk na maaari nilang maranasan. Ilan sa mga karaniwang ginagamit na paraan upang suriin ang financial risk na kaugnay ng long-term investments ay ang mga sumusunod. First is the fundamental analysis. It measures a security's intrinsic value. It evaluates all aspects of the underlying business, such as the firm's earnings and assets. Second is the technical analysis. It evaluates securities via statistics. It considers historical returns, share prices, trade volumes, and other performance data. Third is the quantitative analysis. It evaluates a company historical performance using specific financial ratio calculations. And lastly is the statistical and numerical analysis. It identifies potential risks using statistical methods. Kung susuriin mo ang financial risk gamit ang alinman sa mga pamamaraang nabanggit, siguraduhin mong suriin ang mga trend sa loob ng mahabang panahon. Sa ganitong paraan, mas maiintindihan mo ang mga pabago-bago at pag-unlad tungo sa magandang financial goal. It is important to understand that a risk history does not always imply a future risk too. How to identify financial risk? The following practices help identify financial risk. Considering the risk factors a company might face is a prerequisite for identifying financial risk. Reviewing corporate balance sheet, studying statements of financial positions, exploring weaknesses within the company's operating plan, comparing metrics to other companies of the same industry, and employing statistical analysis techniques to identify the company's risk areas. How to handle financial risk? Napakahirap at mahal na gawain ang lubos na alisin ang financial risk, ngunit mas madali at abot kayang bawasan ang mga panganib. Ang isang individual o kumpanya ay maaaring maalis ang mga panganib sa pinansya sa pamamagitan ng pagkakaiba-iba ng mga investment, pagkakaroon ng tamang halaga ng insurance, o sapat na pondo para sa emergencies. Magandang pagpipilian din ng iba't ibang pinagmulang kita para harapin ang financial risk. Why is financial risk important? Mahalagang maunawaan, suriin at bawasan ang financial risk upang matagumpay na magpatuloy ang isang organisasyon sa matagalang panahon. Madalas na nagiging malaking hadlang ang isang financial risk sa pag-abot ng mga layunin na may kaugnayan sa salapi tulad ng pagbabayad ng mga utang ng maayos, pagkakaroon ng maayos na halaga ng utang, at paghahatid ng mga produkto sa tamang oras. Kaya ang lubusang pagkaunawa sa mga sanhi ng financial risk at paggamit ng tamang hakbang upang maiwasan ito ay makakatulong sa isang kumpanya para makamit ang mas mataas na kita.
In the world of banking, risk management is paramount to ensure the stability, security, and reputation of financial institutions. While much attention is given to financial risks such as credit and market risk, there is another critical aspect that cannot be overlooked, the non-financial risk. Non-financial risk, often abbreviated as NFR, encompasses a broad range of potential risks that may not have a direct correlation with financial factors yet possess the capacity to profoundly impact a bank's operations, regulatory compliance, and reputation. Non-financial risks within the banking industry are diverse and can have a significant impact on a bank's operation, reputation, and compliance, as I said earlier. Let's have the key types of non-financial risks that banks face. The first type of non-financial risk is operational risk. These include risks stemming from internal processes, systems, and human factors. Examples of operational risks include fraud, data breaches, IT failures, employee misconduct, non-compliance with regulations, and disruptions in business continuity. Banks must address these risks to maintain operational efficiency and ensure the security of customer information. The next one is reputational risk. It is another crucial type of non-financial risk. It involves potential harm to a bank reputation resulting from negative public perception or action that may undermine trust and confidence. Poor customer experiences, unethical behavior, failure to meet customer expectations, and publicized incidents can all contribute to reputational risk. Banks should prioritize managing reputational risk as it is directly impact customers' loyalty, brand value, and overall market position. Compliance risk is another non-financial risk. It is significant concern for banks. It refers to the risk of non-compliance with applicable laws, regulations, and industry standards. Banks must adhere to numerous regulatory requirements such as anti-money laundering or what we call AML regulations, know your customers, know your customers protocol, consumer protection law, and data privacy regulation. Non-compliance can lead to severe penalties, legal consequences, and reputational damage, necessitating robust compliance framework. The next one is legal risk. It's another important type of non-financial risk. It involves potential financial losses or legal consequences resulting from lawsuit, dispute, and regulatory actions. Legal risk can arise from contractual breaches, intellectual property infringement, inadequate documentation, or noncompliance with laws and regulations. Banks must establish comprehensive legal risk management strategies to mitigate the impact of such events. Lastly is the strategic risk encompasses risk associated with bank strategic decision-making process, business model, and competitive positioning. It includes risk arising from mergers and acquisitions, entering new markets, technological changes, and failures to adapt to evolving customers' needs and market trends. Effective strategic management helps banks to maintain competitive advantage and sustain long-term success. Non-financial risk can have severe financial consequences for banks, as evidenced by the period between 2008 and 2012. During this time, the top 10 global banks collectively suffered losses of nearly 200 billion pesos. These losses were primarily due to litigation, compensation claims, and operational mishaps. Surprisingly, there were 17 incidents with losses exceeding $1 billion and an additional 65 incidents exceeding $100 million. Such substantial financial implications highlight the urgent need for improved non-financial risk management practices. The impact of non-financial risk goes beyond financial losses. These incidents also inflict significant reputational damage on banks. In an era where customers, shareholders, and public stakeholders closely scrutinize banks, business models, and tarnish to their reputation can have long-lasting effects. Additionally, regulatory authorities are increasingly holding senior managers accountable for misconduct and non-compliance, heightening the need for improvement non-financial risk management. The potential for tighter regulation adds further pressure on banks to effectively mitigate these risks. Despite substantial investment in headcount, governance structures, and operational improvements, many banks find themselves struggling to effectively mitigate non-financial risk. One of the most significant challenges they face is the lack of a clear definition of responsibilities between the first line of defense represented by the businesses and the second line control functions. This lack of clarity creates ambiguity, resulting in inefficient risk management practices. Control functions operate in silos with separate risk identification processes, reporting structure, and IT systems. As a consequence, efforts are duplicated, costs increase, and resources become diluted. Chief Risk Officer or operational risk units struggle to provide a comprehensive view of risk and necessary control to the board and regulators. The absence of cohesive and integrated approach hinders their ability to effectively communicate the overall risk landscape and make informed decisions. To address these challenges, banks are increasingly adopting a integrated approach to NFR management. This approach comprises three components: an enhanced governance framework, a set of enablers, and a changes in the front office approach and mindset. These components aim to reduce the risk of NFR failure, meet stakeholders' expectations, and minimize associated costs. Let's talk first about enhanced governance framework. In accordance with regulatory expectations, banks are establishing a governance model consisting of three lines of defense. The first line assumes ownership and management of risk, while the second line sets control standard and oversees adherence to them. The third line, represented by the audit function, assesses the capacity of the first two lines. While the first line of defense is commonly attributed to business divisions, it is essential to recognize the critical role played by central infrastructure areas such as IT and operations. These areas may not directly face financial risk but carry the highest operational failure risk. Therefore, many banks have expanded the definition of the first line to include these central areas. Additionally, the second line of defense is no longer limited to risk and compliance function alone. Departments like legal, HR, finance, and task are now contribute to the institution's control framework due to their expertise in specific areas of risk. For example, legal provides advice on business transactions and approves legal structures similar to credit risk evaluation. HR establishes and monitors policies related to hiring, promotion, and compensation. This representation of first and second line activities may vary across banks, as there is no one size fits all approach. Each bank must establish a consistent set of principles aligned with its governance structure, operational complexity, and regulatory obligations. These principles should guide future organizational and operating model adjustments, clarifying the separation between the first and second lines, while allowing second line areas to serve as a advisor or service providers. It is crucial to recognize the significance of second line areas in the bank's business model and embed this understanding culturally. The principles must emphasize the responsibility of first-line areas in managing non-financial risk, shifting the focus beyond revenue and cost management. To ensure consistent control management throughout the bank while meeting regulatory standards, the first line may acquire additional expertise. Dedicated control unit assist senior management in identifying and designing improvements, while balanced scorecards can measure control effectiveness and establish threshold and penalties for noncompliance. Ultimately, this principle should instill mindset shift within the organization, with risk management and control at the forefront of senior management and employees' priorities. Once agreed upon, this risk governance principle should be widely communicated across the organization and formalized within the risk policy framework. The Chief of Risk Officer plays a crucial role in ensuring the consistent application throughout the bank. By implementing robust risk governance principle and fostering a culture accountability, banks can enhance their risk management capabilities and ensure compliance with regulatory requirements. Through these concerted efforts, banks can strengthen their overall risk management framework and promote a culture sound of risk governance. The second integrated approach to NFR management is the risk management enablers. Effective management of non-financial risks, or NFR, is essential for banks to ensure regulatory compliance and protect their operations. This section examines key enablers for enhancing risk management in banks, focusing on four essential elements: the integrated risk taxonomy, a prevention-focused control framework, an integrated and forward-looking risk and control assessment, and the quantification of NFR. Let's talk first about the integrated risk taxonomy. To achieve effective integration of non-financial risk or NFR management, it is imperative that all parties involved speak the same language. However, it is common for second-line functions to utilize different taxonomies with overlapping risk type and varied definitions. This discrepancy leads to inconsistencies where conducting risk assessments, generating reports, or assigning responsibilities. In fact, within an institution, the number of taxonomies can easily exceed a dozen, comprising several hundred risk definitions. To address these challenges, consolidating multiple taxonomies into a single unified taxonomy is essential. By doing so, the number of risk type can be reduced to approximately 100, which can be assigned to about a dozen second line function in larger institutions. This consolidation of taxonomy brings numeration benefits. It establishes a common language and understanding of risk across the organization, enabling consistent risk assessments, reporting, and the assignment of responsibilities. It eliminates redundant of overlapping risk definitions, streamlining the risk management process and promoting efficiency. Moreover, a unified taxonomy facilitates better communication and collaboration among different functions, fostering a more integrated, holistic approach to NFR management. The second one is the prevention focused control framework. In building effective control frameworks, prioritizing risk prevention is the key. Instead of solely reacting to risks as they arise, banks should focus on proactive measures to prevent them from occurring in the first place. To enhance control frameworks, bank can implement several strategies. One important approach is to move control upstream, meaning they are integrated into processes from the very beginning. By doing so, banks can prevent risk at their source, reducing the likelihood of incidents and their potential impact. Another crucial aspect is ensuring accurate data capture from the outset. Banks must establish robust mechanisms to capture and maintain accurate and reliable data, as this forms the foundation for effective risk management. Additionally, automating front office system plays a vital role in preventing unauthorized activities. By implementing automated controls and monitoring system rather, banks can minimize the risk of fraudulent or unauthorized transactions, enhancing security and integrity. Mapping risk along value chain and processes provides a comprehensive view of interdependencies. This holistic perspective enables proactive risk management as banks can identify potential vulnerabilities and weak points in their operations. By understanding the interconnected nature of risk, banks can take targeted actions to mitigate them effectively. Through this approach, banks can also have the opportunity to review their business complexities and optimize processes. By streamlining operations, simplifying workflows rather and eliminating unnecessary steps, banks can enhance control effective while reducing costs. By prioritizing risk prevention, ensuring accurate data capture rather, automating front office system, mapping risk, and optimizing processes, banks can strengthen their control framework and proactively manage non-financial risk. The third one is the integrated and forward-looking risk and control assessment. The evidence from audit findings and risk incidents calls the comprehensiveness and effectiveness of internal control frameworks into question. A thorough examination of the sufficient of control will look at the following aspects. The first one is a clear breakdown of the organization and its activities into assessment units. These units should reflect the management structure and provide an end-to-end view of value chains within the bank's operating model. Common components is the second one. This should include risk and control taxonomies, definitions of risk, materiality, and a common aggregation logic. This should be defined for each risk type by the responsible second line. A common set of control attributes is the third one. These serve as a evidence for the design and implementation effectiveness of control and can include characteristics such as frequency of control, the level of automation, and whether they aim to prevent or detect risk events. The fourth one is a clear governance structure across first and second lines. The responsibility for identifying, assessing, validating, and reporting on risk and control should be assigned clearly. And the last one is an integrated management information system for the first and second line. This houses assessments and provides a consistent reporting based by division and risk type. And the last one is the quantification of non-financial risk. Accurate quantification is vital for effective risk management. While credit and market risk can be quantified relatively easily, NFR possess challenges. Banks are adopting various approaches to improve quantification, such as identifying quantifiable risk indicators linked to the top risk. These indicators provide a robust foundation for risk assessments, scenario analysis, risk appetite, risk appetite definition, and capital calculations. Stress testing model incorporating macroeconomic conditions and forward-looking scenarios are also gaining importance. Advanced analytics, including machine learning and the analysis of diverse data sources, offer opportunities to enhance NFR management, reduce fraud, improve hiring decisions, and strengthen anti-money laundering processes. The third integrated approach to NFR management is the changes in the front office's approach and mindset. Banks must make two important changes to manage non-financial risk effectively. First, they should adopt a structured and strategic approach to address identified risks. Second, they need to foster a risk-aware and accountable culture. These changes will enhance risk management practices and drive positive outcomes for their business operations. Let's discuss first the remediation. Regulatory often require banks to address NFR issues and close gaps in their risk management practices. However, these remediation efforts can become extensive and time-consuming, diverting management attention from core business activities. To mitigate future remediation, banks should take the following steps. The first one is engage business leaders. Involve business units in identifying areas where complex operations or business footprints contribute to unnecessary risk. Addressing this risk at their source rather than relying solely on costly controls is crucial. The next one is establish effective governance. Implement governance structures led by the senior business managers. These structures provide direction and alignment for remediation efforts, taking into account interdependencies and change projects. Balanced cost reduction and control enhancement is the third one. Strive for an optimal balance between reducing cost and strengthening control measures. This approach ensures effective risk mitigation while maintaining cost efficiency. Business leaders' active participation supported by expertise from first-line control groups is vital for successful remediation efforts. Additionally, the Chief Risk Officer plays a significant role in establishing a group-wide understanding of remediation activities and building credibility in the control system and risk profile. A robust risk framework alone is insufficient for effective NFR management without a supportive risk-aware culture. Regulators emphasize the importance of risk culture within organizations. The key considerations include risk-aware culture. This one cultivate a culture that recognizes the importance of managing non-financial risk, understanding that not all risks can be fully controlled. Clear communication of company values and norms supported by training, incentives, and sanctions is crucial in reinforcing this culture. Accountability is the next one. Promote clear accountability for NFR management, ensuring that individuals and teams take ownership of identifying, assessing, and mitigating risk within their areas of operation. By holding employees accountable, banks can create a sense of responsibility and proactive risk management. Integrated decision making is the next one. embed risk considerations into decision-making processes across the organization. This means incorporating risk assessment and controls as an integral components of business activities, strategies, and product development. By making risk management an integral part of decision making, banks can proactively address NFR. Ongoing training and awareness. Implement comprehensive training and awareness implications and other roles in managing and mitigating social associated risk. Regular training session and awareness initiatives will help maintain a high level of knowledge and vigilance within the organization. Combining structured remediation efforts with cultural change enables banks to strengthen their risk management practices and effectively address NFR. By fostering a risk-aware culture, promoting accountability, integrating risk considerations into decision-making processes, and providing ongoing training and awareness programs, banks can enhance their ability to proactively manage NFR and mitigate potential risk. To summarize what has been said about NFR or non-financial risk, um, it is important to aspect of effective risk management for banks. NFR encompasses a wide range of risks, including operational, reputational, compliance, legal, and strategic risks, all of which can have serious financial and reputational consequences if not addressed properly. Banks face NFR mitigation challenges, such as unclear responsibilities and siloed control functions. Banks, on the other hand, can strengthen their risk management practices and effectively manage NFR by implementing an integrated approach that include an enhanced government framework, risk management enablers, and cultural change. Prioritizing NFR management allows banks to reduce financial losses, protect their reputation, and meet regulatory requirements, ultimately driving positive results in the business operations.
Next is we have the value of money. First is the present value. Present value is the current worth of money required to achieve a specific future value. It is calculated by discounting the future cash flows to their present value based on a specific discount rate. Next is the importance of a present value. First is we have important for analysis. It is important for businesses to comprehend future cash inflows or outflow from business. Future value calculation is necessary when expecting a specific level of future cash flow. Second is fundamental concept. Present value calculations are essential to determine the value of different investments, such as bonds, stocks, bank deposits, insurance, and pension funds. Third is time value of money. The level of interest rate, inflation, and time periods are crucial in determining the expected return on an investment in the future. The calculation of the current value of future worth helps in making investment decisions. And lastly, inflation impact. To account for the impact of inflation on money over time, either the inflation rate is considered or the expected rate of return from the future cash flow is discounted. Next slide. Benefits of present value. First is we have investment decision. The calculation of the current value of future cash flows in investment aids is making investment decisions. If an investor does not have enough funds to invest in an expected future cash flow, they may choose other investment options. Second is purchasing power. The value of money today is greater than the value of money in the future due to the inflation. Therefore, $100 today may not be equivalent to $100 after a year. Present value takes inflation into account and determines whether today's investment is adequate for future value or future cash flow. And lastly, discount rate. The rate of return on investment is known as the discount rate, which combines the time value of money decreasing over time and interest rate, increasing the value of the investment. The discount rate is used to calculate the present value of an investment in the event of settlement by discounting future value. There are two limitations of present value. First is no guaranteed expected return. The present value is calculated based on assumed interest rate over the investment. But in reality, many investments cannot guarantee the expected rates of returns. For example, banks can change interest rates for which depend on other economic factors, with the exception of government bonds, which have less risk or provide expected returns. No other investment can provide an exact present value. Second is the inflation versus interest. When the inflation rate is higher than the interest rate on investment, the investment becomes worthless. In such cases, people tend to spend their money today rather than investing it for the future since the value of money decreases over time due to inflation. The computation for the present value. The formula for finding present value is present value equals future value divide 1 plus interest rate per period and number of periods. Here are some examples of how to solve present value. What is the amount you need to invest today in a security that has an annual yield of 9% to receive 12,950.29 after a period of 3 years? Where present value equals 12,950.29, divide it to 1 plus 9% raised to the third power. The amount of money that we need to invest is 10,000. Present value equals 1,276.28 divide to 1 plus 5% raised to the fifth power. The amount of money that we need to invest is 1,000 peso. Last example is, what is the amount you need to invest today in a security that has annual yield of 10% to receive 49,731.26 after a period of 8 years? Where present value equals 49,731.26 divided to 1 plus 10% raised to the 8th power. The amount of money that we need to invest is 23,200. Next is we have future value of money. Future value is the value of an investment after earning a certain rate of interest over a specified period of time. It is based on the principle that money today is worth more than the amount of money in the future due to the potential earning power of the money invested. Importance of future value. When you put $1 into a savings account, it earns interest over time. This means that the dollar you deposit today will be worth more in the future than $1 you deposit a year from now. The same principle applies to investments. Future value is a significant calculation as it informs individuals and investors about the worth of investment made today in the future. Next slide. Limitations of future value. Although calculation future value has its benefits, future value does not include the following: adjustments for inflation, fluctuating interest rates, and fluctuating currency values. Each of these elements will affect the true value of money or assets in the future. It's important to remember that future value is an estimation, not a guaranteed metric. The computation for the future value. The formula for calculating future value is future value equals present value plus 1, future value times 1 plus interest rate per period and number of periods. Here are some examples of how to solve future value. If you invest 10,000 today at an interest rate of 9% for 3 years, how much will you have after 3 years? The solution for this is future value equals 10,000 times 1 plus 9% raised to the third power. You, you will have 12,950.29. This means that if you invest 10,000 today and earn a 9% return, you will have 12,950.29 in 3 years. Another example is if you invest 1,000 today at an interest rate of 5% for 5 years, the future value of the investment would be 1,000 times 1 plus 5% raised to the fifth power. You will have 1,276.28. This means that if you invest 1,000 today and earn a 5% return, you will have 1,276.28 in 5 years. Last example is, if you invest 23,200 today at an interest rate of 10% for 8 years, how much will you have after 8 years? 23,200 times 1 plus 10% raised to the 8th power, you will have 49,731.26. This means that if you invest 23,200 today and earn a 10% return, you will have 49,731.26 in 8 years.
Next is monetary policy theory. So what is monetary policy theory? The monetary theory is simply the theory of the value of money or the theory of the price level. When we speak of the value of money, we are concerned with the amount of goods and services that we can buy with our money. We have already mentioned before how money affects our everyday living. We cannot buy food, go to a certain destination, or go to school without money. Since the barter system is already gone, everything that we acquire now is through the means of money. Supply is the main driver of the economic activity. So according to the monetary theory, central banks which control the levers of monetary policy can exert much power over economic growth rates by tinkering with the amount of currency and the other liquid instruments circulating in a country's economy. This power is used to increase or decrease economic activity, depending on the desired outcome. This is why central banks are so influential in the global economy and have such a strong impact on markets and businesses. For instance, if the central bank prints a lot of money, this will boost our economy. People are therefore capable of purchasing a wide range of goods and services. If people have the means to do so, there is a high demand for a particular good good depending on what is available on the market. Understanding monetary theory. According to the monetary theory, if a nation's supply of money increases, economic activity will rise too, and that is vice versa. This is because when there is more money in circulation, people and businesses have more money to spend, which leads to increased economic activity. Conversely, when there is less money in circulation, people and businesses have fewer resources to spend, leading to decreased economic activity. So a simple formula governs monetary theory. So we have here the MV, which M represents the money supply and V is the velocity. So the velocity of money is equivalent to PQ, wherein P is for the price of the goods or services, or the average price level, and Q is the number of goods and services. Assuming there's a constant velocity, that is the number of times per year the average money is spent. When M is increased, the money is increased. Either your price or your quantity will rise, or it could be both price and the quantity will rise. General price levels tends to rise more than the production of goods and services. When the economy is closer to full employment, when there is a slack in the economy, quantity will increase at a faster rate than price under monetary theory. In many developing economies, monetary theory is controlled by the central government, which may also be conducting most of the monetary policy decisions. In the US, the Federal Reserve Board, or FRB, sets monetary policy without government intervention. The FRB operates on a monetary theory that focuses on maintaining stable prices, promoting full employment, and achieving steady growth in gross domestic product. The idea is that markets function best when the economy follows a smooth course, with stable prices and adequate access to capital for corporations and individuals. Types of monetary theories. So here in the Philippines, the power to control the money supply, it's in the government. But specifically, it is vested in the central bank or Bangko Sentral ng Pilipinas. In the US, it is the job of the FRB to control the money supply. The Federal Reserve or Fed has three main levers. First, reserve ratio. The Federal Reserve uses the reserve ratio as one of its key monetary policy tools. The percentage of reserves a bank is required to hold against deposits. The Fed may choose to lower the reserve ratio to increase the money supply in the economy. A lower reserve ratio requirement gives banks more money to lend at lower interest rates, which makes borrowing more attractive to customers. Conversely, the Fed increases the reserve ratio requirement to reduce the amount of funds banks have to lend. The Fed uses this mechanism to reduce the supply of money in the economy and control inflation by slowing the economy down. Second, discount rate. The term discount rate refers to the interest rate charged to commercial banks and other financial institutions for short-term loans they take from the Federal Reserve Bank. The interest rate the Fed charges commercial banks that need to borrow additional reserves. A drop in the discount rate will encourage banks to borrow more from the Fed and therefore lend more to its customers. Third, open market operations consists of buying and selling government securities. The Fed uses open market operations to manipulate interest rates, starting with the federal funds rate used in interbank loans. Buying securities from large banks increases the supply of money, while selling securities contracts money supply in the economy. Monetary theory versus modern monetary theory. The central idea of modern monetary theory is that governments with a fiat currency system under their control can and should print as much as money as they need to spend because they cannot go broke or be insolvent unless a political decision to do is taken. The core tenets of monetary theory have attracted plenty of support under the modern monetary theory banner. The likes of Alexandria Ocasio-Cortez and Bernie Sanders have been championing money creation, describing it as a useful economic tool, while disputing claims that it leads to currency devaluation, inflation, and economic chaos. MMT posits that governments, unlike regular households, should not tighten their purse strings to tackle an underperforming economy. Instead, it encourages them to spend freely, running up a deficit to fix a nation's problems. The idea is that countries such as the US are the sole issuers of their own currencies, giving them full autonomy to increase the money supply or reduce the effect of expansionary monetary policy through taxation, because there is no limit to how much money can be printed. The theory argues that there is no way that countries can default on their debts. The government formulates economic policies to achieve growth and development. These economic policies include monetary, fiscal, and trade policies. Monetary policy is one of the two principal means by which government authorities in a market economy regularly influence the pace and direction of overall economic activity. Importantly, including not only the level of aggregate output, and employment, but also the general rate at which prices rise or fall.
I am Granlican Panganiban.
I am Diana Jane Ferreras.
I am Maria Deidre Kiar Torres.
I am Janelle Samonte.
As we conclude this exhilarating expedition into the realm of finance, armed with knowledge of money risk and the true value of money, remember that awareness is the compass that guides us to financial success. Embrace the challenges, make informed decisions, and navigate the seas of finance with confidence. May your financial journey be filled with prosperity and wisdom.